Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. A new report citing several trade irritants between Canada and the U.S. includes provincial rules around alcohol and the federal government's Buy Canadian policy. The annual document prepared by the Office of the United States Trade Representative also mentions delays with aircraft validation in Canada and high tariffs on U.S. dairy products. The U.S., Canada, and Mexico will decide in July whether or not to renew CUSMA. Shares of GoEasy are taking a hit after logging a deeper than expected loss in the fourth quarter. The results come after the lender recently surprised investors with a surge of bad debts in its vehicle financing business. The Ontario-based firm says it expects loan write-offs to remain elevated for a while before improving later in the year. GoEasy says its long-term opportunity remains unchanged, but did not provide a forecast. It's off by 6% today, 76% over the last year. Shares of GFL Environmental are trading higher today. That's after the Canadian waste management company announced it's buying U.S.-based Frontier Waste Solutions. Frontier manages dozens of sites across Texas, as well as other assets. Frontier's CEO will continue to lead the business going forward. Financial terms of the deal have not been disclosed. And taking a look at the markets right now, it is another good day across the board. You can see the TSX up by 0.81%, and every sector pretty much in the green, being led by healthcare and materials. The only one off right now, energy's off by about 1.5%. Now, south of the border, let's take a look there and see what we're looking at. And a similar response. This is all, of course, on the news from Trump that looks like there's a deal. The U.S. president saying, or it looks like there could be an end to the war in Iran, but Iran is kind of dismissing that. But markets are looking for some positive. And you can see the S&P 500 up by a point, the Dow by 0.9, and the NASDAQ by about 1.5. Well, the global equities are inching higher this morning as investors grow cautiously optimistic about a potential end of the conflict in Iran. That said, markets have seen several similar bursts of hope in recent weeks, often followed by sharp reversals. Joining us now to help unpack what is driving today's move is Nadeem Kassan, the Chief Investment Strategist and Chief Operating Officer at Marnoa Private Wealth. Nadeem, thanks very much for joining us today.
Oh, it's my pleasure. Thank you for having me.
Is this a legitimate optimism or I'll just leave it at or?
I think the markets are looking for something to latch onto. And again, it's hard to tell. I don't have a crystal ball and I don't have a inside look into Trump's, wonderful world, if you will. I think there are telltale signs of, some optimism on the horizon. But again, time will tell if today is, when we hear the president's address this afternoon or this evening, if that is truly, the course for markets going forward.
To you, what are some of the signs of optimism?
I think that, again, approval ratings his approval ratings are pretty weak. There are a lot of, pressure points that are coming from allies in the region that, again, are facing the brunt of this. Again, we're in a midterm election year, and we're probably all rolling up to the gas pumps and filling up at higher prices in the U.S. Obviously, his prime voting base, they're probably not too thrilled with that outcome as well, given that he championed over and beyond kind of none of these forever wars, but also, falling in inflation prices. So I think that's a key thing that, investors are all kind of hoping for. But again, there are signs that, recent efforts, or even on the war efforts, they've been able to, achieve some of their objectives in terms of their Iran's regime.
And I'm just looking here in Toronto, the healthcare index leading the way along with materials. No real surprise with materials on the rally. Are there any specific sectors that are standing out right now with this rally?
Look, I think where, today's a bit of a, a unique day, I would say. There's a lot of optimism. Again, I think if I'm an investor, I would probably step back from the markets and look at areas where there's been challenges, where there's been ongoing headwinds, and then position accordingly. I think, if we step back, even if we get a little bit of optimism in terms of the outlook for the Iran war, I think there are still underlining concerns in terms of the outlook on the trade front, for example, the midterms, and even NAFTA negotiations, which are, again, more relevant for Canadian investors here. So again, I would preface that before getting too tied up with the recent move that we've seen yesterday and then the follow through today. And I'd be looking at sectors that look interesting in terms of their long-term viability, at least over the, 9 to 12 months and beyond. Materials, I think there's a lot of, opportunities within the gold space. Even we've seen gold come in from highs. I think a lot of the operating companies here, whether they're the miners themselves or the midstream firms, they will still stand to benefit going forward, irrespective if gold prices stabilize at this level.
And tech is, if things settle down in the Middle East, is everybody going to suddenly turn their attention back to tech and maybe go, uh-oh?
Yeah, and so that's an interesting, area within the markets, right? So if we look at whether it's from, the 52-week high, if we look at the tech in Canada, the U.S., the sector that is, on a year-to-date basis, it's been an area of weakness, and there's been several factors that have been on companies within Canada and the U.S. within that sector, one of them being AI and then the impact on many of these businesses. However, since the Iran war began, so call it February 27th, we've actually seen this sector in both Canada and in the U.S. outperform. And we've seen multiples compress quite significantly. If I just look at the U.S., for example, the S&P 500 infotech space or sector, it's trading at a market multiple, so about 20 times, call it. This has been an industry or sector that's been trading at, over the last 5 years, somewhere around 25 times. So there's been a significant pullback in the multiple. The outlook over the next 3 years, even if we assume consensus is correct, is about 30% CAGR over the next 3 years. Yeah. That gives a lot of cushion for investors that are looking at that sector in terms of their total return profile. So again, it's an area that we like. I think investors should be looking at that area for opportunities. Okay. Again, there's multiple headwinds that have been weighing on companies operating in that sector, both in Canada and US. And again, as we've said at the beginning of the year, both to clients and even on BNN, the stock pickers market, find those companies that are a bit more, obviously a lot more resilient throughout the cycle, where the headwinds have really pressured.
I want to jump in because we're almost out of time, but I want to get to a couple of stocks. Nike, your thoughts on what's unfolding there? That is a struggling company right now, isn't it?
Yeah, so look, very quickly, just on the more idiosyncratic elements, company reported results that were more or less in line to above expectations here for Q3. Looking out, the guidance was definitely weaker. They're seeing some, fruits of their labor in terms of North America and running, but China, EMEA are all weak. If we take a step back and just look at the sector or nearest peers, Lululemon, Under Armour, VF Corp, they're all down quite significantly over the year. Over the last 5 years, that group is down about 50%. So there are elements that are more unique to Nike. But again, if we look at the sector, there's been pressure points that have been, been headwinds for Nike and its peers over the past several years.
All right, and their CEO saying, I want to move to inspiring and driving growth and having fun. Tough to do when the situation's like that. And one other one we want to sneak in here, GFL's buying.
Yeah, so GFL closed an acquisition, Frontier Waste Solutions, overnight. They also made 7 other tuck-ins, approximately 1.4 billion US in Canadian dollars for Frontier, along with the tuck-ins. This is going to add about 400 to about 450 in revenue synergies or revenues again. And I think the deal was done at about 11, 12 times EBITDA. The shares are trading around 13. If you factor in the synergies that are expected, again, this comes into a high single digit EBITDA multiple. So definitely consistent with strategy. I think that we're looking at it's a portfolio holding, a recent addition, which we picked up on weakness. Is going to be monitoring the debt levels. We want to see progress on realizing these synergies, integrating the businesses. Again, it's a good element to have the CEO on board and having the CEO along with several of the shareholders at Frontier acquire shares of GFL along with again other investors too. So again, this is a good fit, and we'll be watching for leverage levels and just the execution of this acquisition.
Okay, we'll wrap it up there, Nadeem, but thanks as always for joining us.
It's a pleasure. Thank you for having me.
Cheers. Nadeem Kassam, Chief Investment Strategist and Chief Operating Officer at Marnoa Private Wealth. Up next, we'll take a look at the U.S. retail sales that came out today and how the American economy is faring overall. A slight gain for U.S. retail sales in February after a decline the month before. My next guest believes consumer spending habits will continue to support ongoing economic growth in the U.S. Let's hear more on this now from Russell Price, Chief Economist at Ameriprise Financial. Russell, thanks very much for joining us.
Good morning.
All right, the numbers out today, slightly better than anticipated. Where do they fit in?
Yeah, 0.6 gain for February is actually pretty good, especially considering the bad weather that we had during the month. Of course, the weather was even worse in January, and we saw a decline in January. But the February numbers were pretty broadly distributed as far as positive. One of the only sectors that was down was furniture sales, and you would expect to see that during bad weather. We also had a bounce back in automobile sales that offered a little bit of upside to the overall number. And on a year-over-year basis, sales were about 4% higher. So that's indicative of consumers that have been seeing pretty good income growth and spending. And so it looks like that's continued.
Anything in the numbers that were a little surprising or caught you off?
Well, the one thing I thought was a little bit surprising was sales of construction materials were quite good in both January and February. When you have bad weather like we did this past January and February, typically new home construction and remodeling activity declines momentarily. And we didn't really see that, at least as far as sales of building materials goes, at least this past quarter.
Now, do we know why? Was that people marking prices down to get people in, or is there demand, a growing demand somewhere?
Well, I think if the prices were marked down materially, I think that would have taken down the overall sales numbers. So I do think that it's indicative of ongoing relatively solid demand. We did see new building activity from home construction numbers from the Census Department as being down in January. But again, I think that's largely weather related, and we should see a pretty strong bounce back in February and January and March from those numbers.
Okay, and now overall with the U.S. economy, what we saw the numbers today, and then now we can factor in, of course, everything with oil and what's happening in the Middle East. How is the U.S. economy looking right now?
Yeah, the situation in Iran and the resulting jump in energy commodity prices, along with what we'll see for higher prices for food that we get from fertilizer costs and also for plastics, we should see a slowdown, expect to see a slowdown in March and probably the second quarter, as long as the situation in Iran persists. But generally, we came into this year with the consumer in pretty good shape, primarily from a debt burden situation. And typically, when consumers are in good financial shape, that's good for economic prospects. When consumers are deep in debt, That's not good for economic prospects. It's really quite often just as simple as that. So we came into this year we're looking for inflation to subside. Of course, we'll see inflation now jump up once again. We'll probably see it around 3.5% in the next few months if oil prices remain around $100 to $110 a barrel. That would equate to about $4, maybe $4.50 in gasoline. That will boost up inflation momentarily and take down the pace of economic growth, hopefully momentarily. And as the situation resolves, we should see the economy regain momentum.
Now, we did hear talk of possibly $150 a barrel full oil. We briefly got up to that 120 mark. It seems like it's calmed down. What would be concerns that might drive it to 150 if the war isn't resolved, or would there other factors be at play?
Yeah, the two main factors are how high prices go and how long the situation persists. How long the situation persists is going to continue to bump up oil prices because the reserves that a lot of countries are relying on currently are being worked lower. So those reserves just won't be in place if the situation were to continue for several months. That being the Strait of Hormuz being closed. So the longer this situation persists, we are going to see higher energy prices and probably higher prices for food and plastics and things like that. And so we could see $150 a barrel if the situation were to last. We estimate probably between 5 and 7 months. If it were to last for a full year, we could see it move up above $150 a barrel, and we could even see it at $200 a barrel. But again, that's a low probability scenario in our estimation.
And then in the middle of all this, there's some good numbers when it comes to jobs. How do you see that continuing, that trend, or does oil play a role in that, maybe going the other way now?
Yeah, we had a pretty good ADP employment report this morning. 62,000 net new jobs created last month in the private sector. It was lopsided, however. It was basically 85,000 new jobs in the small business sector. That is a bounce back from what had been the case last year. Throughout much of 2025, small businesses were shedding workers, primarily because the tariffs were having an outside impact on them, and they just didn't have the resources available to fill out all the additional paperwork and deal with cost structures and pricing structures, things like that. So small business hiring really came to a halt and even declined. This in February, it bounced back pretty well, but we did see small declines in medium and large sized businesses. And I think that's indicative of maybe those businesses becoming a little bit more concerned about just how long the situation with Iran lasts and what that might do, at least temporarily, to their demand for labor.
Does it look like then we're coming out of the slow fire, slow hire?
I do think so. We are starting to see a little bit of that in the late months of 2025. And I think it's very comforting to see that rebound in small business situation. Also, we're starting to see better growth in the manufacturing and services sectors of the economy. Manufacturing, which also came out, is now above 52, the PMI for manufacturing, above 52 for the last 3 months. We haven't seen that since 2022. And that's supported by good numbers within that report for new orders and production values. The employment number is still slightly below break even, but as long as the new orders remain positive and production volumes continue to grow, we should see improved hiring from manufacturing. And we are looking for manufacturing to add about 6,000 net new jobs in Friday's employment report.
Okay, we have to wrap it up there, Russell, but thanks very much for joining us.
My pleasure. Russell
Price is chief economist at Ameriprise Financial. Coming up, today's market drivers with Bloomberg's Monique Malima. We'll see why Ivanhoe Mines is on her radar. Time to take a look at today's market movers, and we're joined by Bloomberg Equities reporter Monique Malima. Monique, thanks as always for joining us. First up, Ivanhoe shares are dropping right now.
Yes, so Ivanhoe, their shares fell as much as 11% today, which is the biggest drop since June. And this comes after the company announced yesterday that they were cutting their production guidance for 2026 and 2027 at their largest mine, which is in the Democratic Republic of Congo. And analysts say that this guidance cut was actually surprising. There have been ongoing issues at the mine, but they weren't expecting to see such a big reduction in production for the next 2 years. And the company also announced that costs are going to be higher as they're trying to kind of revamp this mine and get things back under control. So we've seen a number of analysts cut their price targets on the stock today, as well as downgrade the stock on this news, with the recovery expected to take longer than expected.
I'm just looking almost a 25% cut. That's a decent amount. Next up, Algonquin Power. What's happening there?
So Algonquin Power, their shares are rising today after Barclays initiated coverage on the stock with an overweight rating. They say that the company's turnaround plan has been working and they're seeing improvements on the balance sheet. But they note that the company has been underperforming its utility peers over the past 3 years and are continuing to underperform even as they are making these improvements. The analysts also see upside coming from monetizing the hydro assets, from data center power demand that they can capitalize on. And the company also announced recently that they are considering potentially re-domiciling from Canada to the U.S. And analysts note that if the company does choose to pursue this, that there would be tax benefits from this that could also provide some upside. So analysts just see a lot of catalysts ahead for this company and are seeing the work that the company has been doing to try and make improvements, seeing those actually come to fruition now.
All right, and airline stocks were taking a bit of a hit through this war in Iran, but now some bounce back as well.
Yes, so the airline stocks are higher today. This comes after President Donald Trump said that the war in Iran could end in the next couple weeks and signaled that a ceasefire could be potentially approaching. And this is something that's been seen as really positive for the airlines because oil prices have been rising due to the constraints in the Middle East right now. And with the Trump announcement, we've seen oil prices come back down today, and analysts are saying that they're also seeing the fuel prices for airlines come down materially on this news. So they're really hopeful that if we do see an end to this war soon, that those fuel prices won't be impacting airlines as much as they might have potentially.
All right, yeah, they just seem to be getting off the ground and getting hit again. Getting hit also memory stocks. What's going on there?
Yes, so memory stocks were also a group that was seeing their stock prices go lower throughout the Iran war. Part of this comes down to risk sentiment. The memory and chip space is particularly dependent on kind of the AI demand and some of those areas that can be a little more risky in the markets. So as there were fears around the war, some people were pulling out of risk assets, but they were also being hit, particularly in the semiconductor space, because semiconductors for production use helium, and a large supply of helium comes out of the Middle East and was being constrained due to the closure of the Strait of Hormuz. So analysts say that with the potential end to the war, the impact of the helium shortages is expected to be manageable for these chip stocks, so that's helping them as well. But they note that if the war does continue much longer, that it could put other constraints on some of the other stocks in the sector, such as the analog stocks, that could see some of their recovery kind of stall. So they're really hopeful that if this war does come to an end soon, we're going to see more upside for these stocks as well.
Okay, we'll wrap it up there. Monique, thanks as always. Bloomberg's Monique Malima. Still ahead, the Artemis 2 mission is set to launch this evening. We spoke with a Canadian company working with NASA to make it happen. That conversation next. Shares of Group Dynamite are getting a boost today. The retailer reported fourth quarter profit that more than doubled compared with a year earlier as revenue rose 45%. The results were driven by increased in-store demand and strong online sales. Dynamite also plans to expand its Garage brand into the UK this year. The retailer posted a strong outlook for revenue growth for the full year, but cautioned for multiple risks, including tariffs and a decrease in customers. Shares of Tilray brand are falling, down about 3.7%. The cannabis company issuing a full-year profit outlook that beat estimates, but investors seem to be focused on its beverage division. That unit continues to face headwinds and saw sales drop 24% compared to the year before. Tilray has been expanding its portfolio of craft beer and spirit labels and most recently bought BrewDog's operations in the UK, Ireland, and Australia. Shares of RHR plunging. Look at that, down almost 24%, 23.6%, after the home furnishing company reported profit and revenue for its latest quarter that came in below Wall Street expectations. It also issued a revenue forecast for the first quarter that missed estimates, analysts say. The company's outlook is pressured by a sharp drop in demand, as well as execution and supply chain disruptions. And taking a quick look at the markets, another up day after that big rally yesterday on news of a potential peace plan or some kind of a settling down in the Middle East. The TSX up right now by 0.88%. South of the border, lots of green there as well. You can see S&P 500 up by 0.93, Dow by 0.86, and look at the NASDAQ after that big jump yesterday of nearly 4%. It's up another 1.38 today. NASA is expected to launch a new rocket to the moon today. It's called Artemis 2. Canadian astronaut Jeremy Hansen will be aboard to become the first Canadian to leave the Earth's orbit and venture into deep space. Canadian space company MDA Space will also be a part of the historic moment. For more on this, we spoke with Mike Greenlee, the CEO of MDA Space.
It's a historic day. It's the first time that humans have been back towards the moon in over 50 years. The first time that a Canadian has ever gone to the other side of the moon. And this group of 4 astronauts it'll be the furthest that humans have ever traveled from the Earth. And so the historical aspects of the moment. And it's the opening of a new phase, of opening up a new economy. So for the Canadian space industry, which we're a key member of, the opening up of the return to the moon, the establishment of living and working on the moon, which Artemis program is constructed to achieve over the next several years. This is the first very important step in doing all of that, with this group going out around the moon today. And then the next group in 2028, there'll be 2 landings on the moon with humans starting to set up living and working there.
All right, I want to bring Nate into the conversation. Nate.
Mike, this is a great day, exciting day for you and everyone involved. What for Artemis in general, obviously one of the big goals is to return to the moon, but what are some of the other main goals of Artemis over the coming years?
For sure, well, the primary singular sentence is to live and to work on the moon, for sure. That causes us to sort out as a space community all sorts of different issues, determining how to have the reusable rocket systems that can go back and forth to the lunar surface, to be able to put communication systems on the moon, which MDA Space will be a part of, or is currently a part of, to be able to put rovers on the moon, to be able to drive around once you're there and move logistics and cargo, to be able to build habitats, to be able to look at the ability to have sustainable food sources on another planet, and then to start to explore that planet in terms of looking at what types of resources can be available to be able to do things like create fuel, to be able to then have bases from the moon, to be able to move on to further out into the planetary system. So a whole series of technology achievements will be part of the Artemis missions. In addition to a lot of human science achievements, we've studied the performance of humans in space for the last 25 years on the International Space Station. Now, obviously, putting all of that to work to be able to continue to study and advance having humans live and work on another planet with different characteristics as we now figure out how to live and work on the moon.
And for MDA itself, Canadarm3 is a big thing for you. NASA may not be using that now. Where do you see yourself fitting in with Artemis and with the space programs in general?
Yeah, for the Canadarm3 program is Canada's program to contribute space robotics to the Artemis program. Canada, of course, through the Canadarm history, is the world leader in space robotics with the most experience of any nation in this regard. And so, right now we're in review to look at, can we take the robotics that has been targeted and been developed for the lunar area, previously targeted at Gateway, the space station that was to orbit the moon, which has now been paused to focus on getting onto the lunar surface, and then target the final design of those robotics at the uses on the lunar surface. There'll be a number of robotic needs on the lunar surface to be able to unload, manage cargo, do daily tasks. And so, we're looking at that at the moment. So as a company, we would expect to continue to be involved in robotics on the lunar surface, where we have a very strong rover capability. MDA Space has had technology on rovers on Mars for the last 15 years. We've been involved in the design of a new rover system with the European Space Agency and various teams for Mars called ExoMars, which is planned to go up in the future. And we're involved in a couple of different lunar rover programs to put rover systems onto Mars. And so for sure those items, and then we're involved in a range of other conversations where our technologies will be applicable.
Nate, I just wanted to ask one quick follow-up question. What's it like to try and adapt something that you had for going around the moon? Now you got to look at it for maybe being on the moon. How easy or difficult is it to do that?
A lot of things are the same, like the command and control and communication systems, figuring out how to have robotics control instead of 400 kilometers up at the International Space Station, now doing that 400,000 kilometers out at the moon. All of that is the same. Those robotic systems have been built for that and designed for that environment. In addition to dealing with things like lunar dust, for example. And so a lot of the characteristics are the same. The biggest change from going to a space station down to the surface would be the impacts of gravity, because now you have a gravitational field that's there. So you'd have to have, you'd probably change your joint strength, for example, in addition to maybe your segment lengths of your robotic system for different tasks and different purposes. So definitely an achievable adaptation for Canada to consider to be able to continue to contribute robotics to the lunar surface.
All right, Nate, we'll give you a last question.
Mike, you previously mentioned traveling beyond the moon, and I think a lot of our watchers would love to know, what does this mean for Mars and the likelihood of humans being on Mars in some time in our lifetime?
All of these activities on the lunar surface is definitely in preparation to be able to go further and to be able to live and work on Mars someday. So with the moon being a much closer planetary planet to work on, then that allows us to be able to work out all the issues around sustained rocket highways back and forth to the moon, to be able to move people and logistics back and forth to a habitat there, to be able to work through all the issues around habitats, living and working, food, everything I mentioned earlier. So the lunar program is important for the moon itself, but it's also important to sort out all of those issues so that we can go even further away to Mars in future years.
That was Mike Greenlee, CEO of MDA Space, with our featured guest, Nate Tuft from Manulife Investment Management. Coming up, why some investors say the AI boom isn't just noise, but the start of a massive capital spending cycle. More on that next. AI is top of mind for many investors with the surge in corporate spending and the race to build out data center capacity. Now, earlier, we sat down with Nate Tuft, CIO and Senior Portfolio Manager at Manulife Investment Management, who believes the real story isn't just hype, but a major capital investment cycle.
We do believe that this is a big, big secular theme, that it will be in place for quite some time. And the amount of capital expenditure into the infrastructure required is massive and hugely supportive of global economic growth activity. In fact, in some geographies, it's making up a decent chunk of economic growth activity. And we think that trend will continue. That does not mean everyone can win, however. And this is where I think we caveat by our more positive views on AI, is there will be winners and losers. And we are starting to see the market really delineate between those winners and losers, and expect that to continue to be the case looking forward.
Where are the early winners showing up right now?
Well, the early winners continue to be the folks that are building the infrastructure, the folks that are supplying the componentry, such as the semiconductors, such as the infrastructure that goes into the grid and electrical build out, et cetera. So those have been the winners. But more recently, what we're starting to see is signs showing up where the adopters are starting to begin to gain some ground. And the ecosystem of AI is actually broadening, not shrinking, as it relates to the broadness of the participation in this theme. And so the winners have been what we call the enablers, the folks building things, but we actually think the beneficiaries, the folks that are adopting it, will likely be the winners more so looking forward.
All right, and if we start seeing money move towards the adapters and it's paying off for them, what happens like to the Mag 7 and where do we see them heading?
Well, we've already seen the Mag 7 begin to disappoint. They haven't moved much over the last 6+ months, and we actually have seen a number of them trade down quite meaningfully. That doesn't mean they're dead. They aren't. They are actually massive companies that will continue to print massive amounts of earnings. But the market has really fully priced them in many ways. And this is the reason why we're starting to see a broadening of this theme beyond just the Mag 7. And we think that will continue. So we wouldn't necessarily be outright underweight the Mag 7, but we would be looking to diversify through a broader exposure for AI. And that includes other sectors beyond technology. Things like in the healthcare space, such as in the industrial space is another one. Very data-intensive industries that can use AI to simplify and provide more efficiency gains. The financial sector comes to mind. So there's a lot of ways to play AI beyond just the pure Mag 7s and the big tech names.
Now, it seems like this has been the year that people are now starting to implement. What if that implementation doesn't deliver the returns that people were expecting with AI, that they were hoping it would bring? What happens then?
That's the big concern of the market. And that's when you see the market AI names sell off, it usually has to do with the massive amount of cost that's going into this and whether the payoff will be big enough. And this goes back to the theme that we said earlier about not everyone can win here. And the market is really starting to sniff out the winners and losers. And you have seen names that have spent a lot and it's starting to really eat into the firm's earnings and cash flow dynamics being penalized quite a lot. But you're seeing other names who have a much more balanced approach to their capital deployment and their earnings delivery continue to benefit a lot. And this is what the market is really starting to sniff out between the winners and the losers. And I think that is something to focus in on, is you need to avoid those names that are spending a lot of money and it's really starting to question their balance sheet and income statements when it comes to their quality.
And any concerns about the circular spending and investing that we're seeing?
To an extent, yes. You do have to be careful or aware of that. But at the same time, this isn't new. I mean, the reality is the tech industry and many industries are highly interconnected. And so there is a circular dynamic to spending. It might be a bit more extreme here right now, particularly with some of the providers of that capital. But at the same time, this is something that happens in a lot of industries. It's a highly interconnected world, and supply chain dynamics and the underlying relationship between companies is hugely important to success, just as it is a risk when something goes wrong. And so we're aware of it, conscious of it, but at the same time, don't buy into the massive narrative that it's a complete negative.
All right, what kind of a role do you think government's going to play in all this? Like through the either OBBB, one big beautiful bill, or tailwinds from defense, et cetera?
Yeah, this is, I think, a key area. One of the sectors that we think is a huge beneficiary from AI, and it's in some cases still underestimated, is the industrial sector. And it's not just because industrials help with the AI story from an infrastructure build out, but it's also because industrials are linked to a number of other key things that are happening globally, such as the build out of energy infrastructure, partly related to AI, but the need for energy in general. Defense spending, most of that lives inside the industrial sector. We have a major war and conflict in the Middle East. Guess who benefits from the build out of additional infrastructure when it comes to rebuilding and or building new facilities for energy? It's industrials. And so there's a lot of themes that are tying into the industrial theme that will benefit that sector. AI is one of those, but there are other things driving it as well. And it's a high quality sector with reasonable valuations.
All right, that was Nate Tuft. He is the CIO and Senior Portfolio Manager at Manulife Investment Management. Coming up, organizations are racing to adopt AI tools, but others are struggling to keep up. We'll take a look at what's holding them back after this. AI tools continue to raise expectations around productivity and efficiency, but many Canadian companies are still slow to adopt these technologies into their day-to-day operations. Joining us now to discuss how they can navigate this shift is Steve Leslie, CEO of Quadbridge. Steve, thanks very much for joining us.
Great to be with you today, Roger.
We're hearing more and more about how AI has to be incorporated. How successful are Canadian companies at it right now?
Yeah, I would say we're seeing a lag in Canadian organizations in the adoption cycle. If you look at the marketplace in Canada, and we're focused predominantly in the mid-market space, but if you look at the marketplace in Canada, it is a marketplace that is a lot of SMB. It is a marketplace that is not a lot of enterprise accounts like the marketplace in the U.S. The U.S. has a lot more scale, and in those enterprise businesses, they are moving faster on adoption than the mid-market space. But I would say that's the key leg in the Canadian marketplace.
And what is stopping them? Is it that good old Canadian caution, or are there other fears?
Yeah, I would say it's probably three things. The first thing is, if you look at scale of capital in Canada and specifically around innovation, localized innovation in AI, it does tend to move to the US when companies get to a certain scale. So that's one big gap. The second big gap, I would say, is it's a pretty big lift to implement these technologies. I heard your last guest talking about all the investments going into all of the technologies, but when they land with a customer, it's a pretty big deal to implement these technologies. So that's the second area. The third is interesting. In our research, what we're seeing is leadership is a big deal. The gap in leadership in this specific area.
Okay, and let's talk about that first. Then, what's missing? I mean, are you talking CEOs not knowing where to go with this, or CIOs? What's their technology?
Yeah,
who's afraid of it, and why are they afraid of it?
Yeah, I would say our research tells us that in order for these projects to get off the ground, it has to have CEO sponsorship. It has to have executive sponsorship. So therefore, if you think of how these innovation projects get off the ground before, often it was localized in IT, and they would drive it through the organization. With these technologies, because they're so broad-based, it does require executive sponsorship to move them forward. And the other thing I would add, Roger, is, artificial intelligence at scale is a pretty big deal. And, I would liken it historically to the invention of the printing press. Like, that's a big deal. And leadership has to understand the impact of automation technologies, not in the next year or two, but probably in the next 5 or 10 years. It will dynamically impact industries.
And are there industries that are moving ahead with this faster than others? I imagine tech, but are there other industries that are starting to embrace this at a quicker pace?
Yeah, I would comment specifically on mid-market. We're not seeing early movers at an industry level in mid-market. What we are seeing is probably about, according to our research, probably about 10% of the market has moved to adopting AI at scale. And what I mean by that is they're implementing agentic and automation technologies, and it's integrated into their infrastructure. So there's about 90% of the market that is in experimentation mode. And again, that comes out in our research that we've done with our customers in the mid-market space.
So that must bode well then. I mean, it feels like there might be a sea change at some point as everybody realizes what it can do, and all of a sudden they embrace it fully. Do you think that's going to come?
Yeah, definitely. Like, we do an event every year called Qubits in Montreal in April, and we bring in customers from the United States and Canada. We use our research from an assessment we do with all of our customers in November, and they build the agenda for this event. And it's really a learning event. And it's really interesting, Roger, the number one thing that our community, and this is IT leadership, wants to focus on is building the leadership skills to adopt these technologies. And those leadership skills probably fall into 3 categories. Number one, the ability to reset expectations on the potential of these technologies. The second thing is a much stronger focus on prioritization in the organization. And the third thing, which is the most critical and most important, is to make sure that your data is structured, it's governed, and it's secure. Because without that, you will not be able to adopt these technologies at scale.
And are you seeing CEOs open to that?
For sure. No, and I would say what we're projecting and what we're seeing in the market over the next 1 to 3 years, adoption will start to accelerate in mid-market. This year, 2026, we're still going to see a lot of experimentation, more localized, experimentation with agentic tools, experimentation with learning models, with Copilot and things like that. And what we expect is 2027, we'll start to see more broader-based adoption in the mid-market space.
All right, we have to wrap it up, but just one quick question. We're not too long going to answer. What country is leading the way?
Well, the U.S., just by sheer scale. Europe is obviously doing very, very well. And, back to your opener, Canada, we have work to do, but I do believe with the right focus, we can get to where we need to be.
All right, I got to wrap it up there, Steve, but thanks very much for joining us.
Thank you, Roger. Steve
Leslie is the CEO of Quadbridge. Market Calls coming up next. Joining us today, Michael Sprung, president of Sprung Investment Management. His focus, Canadian large cap stocks. Thanks for watching Morning Markets. We'll see you back here tomorrow.